US fixed income market has been on a rollercoaster ride this year, and now it's bracing for a steep rise in Treasury issuance. This is Inside ETFs, and we're talking fixed income. US Treasury issuance is set to approach $500 billion this quarter, and the risk premium is on the rise. 77% of bond strategists polled by Reuters think demand will lag supply, both this quarter and the next. Meanwhile, big rises in equities have stolen all the limelight. In this landscape, though, should you consider a fixed income ETF? Well, Eric Lutton of Sound Income Strategies thinks so. Eric, why should you buy a fixed income ETF now?
Well, again, it depends on what the manager's working with their clients. Once they look at a rate of return or a certain income level, they'll have to back into how much fixed income they need. And fixed income ETFs, especially actively managed ones like ours, they'll work hard to get a higher yield than maybe the index or some passive funds. So if you can get much higher yields, I think the bond aggregates yielding over 4%, where a lot of active fixed income, you're going to see 6-7% yields. If you can lock those in and get diversification, it makes a pretty solid case for going into fixed income ETFs.
This market has really been volatile, though. How are you hedging against this unpredictability?
Well, correct. As you've seen, the MOVE index, which measures the volatility of U.S. Treasuries, we're just below 100 at the beginning of this year, which it spiked up to 140 during the first week of April as tariffs spooked investors and equity markets sold off by, I think, about 20% in the NASDAQ. Bonds rallied. The 10-year reached a low of 385, spiked up to 460, so extremely volatile. But as markets got underway in May, it started to move back. We saw volatility come down. The MOVE index moved it back down to about 85, still above pre-COVID levels, but volatility has come back down as we've had those 90-day pauses and extenuations in the tariff war back and forth.
Well, you pointed out that higher rates generally mean higher dividends, but this is a rate-sensitive sector, isn't it? How can you manage that in an environment where it's hard to predict what the Fed might do next?
Correct. Well, we've added to traditional bonds, traditional fixed coupons, we've added BDCs and REITs. For those that don't know, business development companies, they kind of act like banks, but they're not banks. They're working with middle market firms to loan out money. So it's floating rate underlying debt, first lien debt. So as rates go up or stay higher for longer, those BDCs can throw off higher dividend yields, pay out more on a quarterly or monthly basis, depending on the BDC. And so that helps with traditional fixed income. As rates go up, as you know, fixed income gets punished a little bit.
We saw, Eric, in this week's CPI number that inflation is again on the rise. If the Fed can't cut for some time, and maybe not this year, does that worry you at all?
It doesn't, because we're positioned for that. I wasn't expecting too many rate cuts this year, even though the market really wanted it, even though the administration's pressuring Jay Powell to cut rates. If you look at the numbers, inflation's still sticky, and we haven't started receiving a lot of the tariff information yet in the CPI numbers. It's starting to tick up, I think, but I don't think there's a good case for the Fed to cut given the debt increasing and the tariffs. So I think we're going to stay put for a while, even though there's pressure on them to cut.
Do you think, though, that investors should be concerned that the bond market is oversupplied, especially given the amount of US Treasury issuance we're seeing?
That is a concern. Everybody's been discussing this. I think the Secretary of the Treasury has mentioned several times that they're going to start packing the T-bills in the short end of the curve, and everybody's worried about supply. Another factor that could happen is all these tokenized crypto coins. A lot of these are going to be backed by Treasury, so there could be a big demand for T-bills with this Genius Move Act and some of the other things that are coming down the pipe for crypto.
With Eric Lutton of Sound Income Strategies, don't forget you can watch more videos on Reuters.com.